This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Tian's picture saying looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA finally printed a big drawdown this week, with crude oil drawing down 3.4 million barrels nationally, Cushing, Oklahoma drawing down 702,000 barrels, gasoline drawing down 2 million barrels, distillates was the lone build on the board at 4.9 million barrels, for a net petroleum drawdown of 500,000 barrels. U.S. production ticked back up 100,000 barrels to 13.3 million barrels, returning to the level it plateaued at. If memory serves, we got to 13.3 million before the pandemic, then got back to that figure after the pandemic. I don't think we've ever seen a weekly print of 13.4 or higher. If we did, it was only one or two prints. So we'll see if we get above that level, but we're back to the all-time high, I believe. So we'll have to see if it plateaus here or continues to move higher. Overall, we've seen a big $12 rally from a 72 handle at the bottom to an 84 handle at the top, corrected back down to an 80 handle. Now we're bouncing nicely off of that 21-day moving average down at 80.04, but still closed Wednesday well below the 5 and 8-day moving averages, which are co-located at 82.62 as of Wednesday's close. It's unclear whether or not the market can resume a rally above $85. I'm flat here and focused on gold and uranium.
You know, Eric, overall for me, crude oil has actually been behaving very well. It's now close to a month of trading above its 50-day moving average. It has beaten many Fibonacci zones of the April-May market correction. And so far, the dip has been contained above $80. And even though we could easily still have one quick little dip down towards $80, the longer the bulls keep this consolidation at good, healthy levels and defend the price action, the more likely it is to be a continuation pattern that might see crude oil make a punch toward $90 in the months to come. It'll be really interesting to see how that develops. Now let's get to the S&P 500. I want to get you involved in the conversation here, Nick. What are the levels you're watching?
Yeah, Patrick. So right now the spot price on SPX is approximately $56.30. And we have an implied move for next Friday's July 19th monthly OPEX at 70 points. Therefore, the upper implied move is 5,700 and the lower implied move is 5,560. Right now, we have no key resistance as we're at all-time highs, and we have key support at 5,500. And to note, there's a gap right now from July 11th at 5,375, which I think we fill in the next couple of months or so. But right now, we're up 4.85% in just a month, and I think we're seeing the blow-off top right now as we speak. I'm inclined to think that we see some downside coming after the July OPEX and into the September FOMC meeting.
It's interesting you say that because from a seasonality perspective, when we go into the latter part of the third quarter is the tendency for the market to have less liquidity and it tends to get heavier. And so it's interesting that the market is ripping this way. What's particularly interesting is while the S&P measures technically to move towards 5,800, and it's entirely plausible that it can head there on the very short term in this parabolic rise that we're witnessing on the markets. what is the underpinning problem is the fact that the breadth of the market is still very poor. Like we are still at 51% on the breadth indicators that we show on page 4, which is we were at 60% back in June, and in May we were at 65%, and in March we were at 85%. There's just a lack of participation. This continues to be solely the mega caps rallying. Nvidia was up again. We had Apple ripping to all-time new highs, Google and Microsoft all pushing. When you have these super mega caps doing all of the work, then the market it lacks that breadth. And what we see is that at this stage, we're going to see these mega caps at some point run out of momentum. There's just going to be an upper ceiling of where the buying comes in. And the question becomes, can the market breadth widen to counter it? Or will we see a very deep mean reversion when we see those short-term blow-off tops? And just to kind of put context into that, Nick, is on page 5, I have that S&P 500 equal weight index, which basically equal weights all of the 500 stocks. And you can see we're nowhere near the June highs, nowhere near the May highs, and nowhere near the March and April highs. And so this rally, while it seems spectacular, is really just being driven by a handful of stocks, and that usually doesn't end well. And those are all Nasdaq stocks. So on page 6, I have that chart. Let's start off with your levels here, Nick.
So right now on the Qs, we have a spot price of approximately 503. With an implied move for next Friday's July 19th monthly OPEX of plus minus 10 points. Therefore, the upper implied move is 513 and the lower implied move is 493. Right now, we have no key resistance as we're at all-time highs, and key support resides somewhere around 485. Notes right now on the Qs are that we have a gap at 466 from June 11th, and that we're actually up since then by about 7.5% in just a month. And in the month of July thus far, we're already up 5%, where over the past 16 years, the Nasdaq has averaged a return of 4.64%. So I'm inclined to think that we see for the remaining month of July a negative return overall from this level, which means that perhaps selling bear call spreads out of the money, in my mind, is a decent idea. I'm also more inclined to look at the small caps as they haven't really done too much overall. So I'm bullish on small caps and bearish on big tech going forward.
From the technical level, the measured move on the upside of NASDAQ is about 2150. So I think that there's room for the short-term move to finish as we might see Apple approach 240. We could see Microsoft take a shot at 500. There could be a few more of these finishing moves, but at some point this market's going to get exhausted and we're going to see some mean reversion. Clearly on the short term, this thing just seems to be gaining traction on the upside. It'll be interesting to see where that turn point develops. Now on page 7, we have the volatility index, and what we continue to see is that the volatility remains at multi-month lows and is just sitting there in that pocket where you could be at this point pretty much ensuring your portfolio gains for an incredibly reasonable price. What are the levels you're seeing on the VIX?
So right now with the VIX sitting at around 13, we can expect intraday moves of about 0.75%. Now, for the last month or so on the S&P, which correlates to the VIX, we've seen intraday movements on average of about 0.75%. So we've seen realized vol essentially in line with implied volatility. However, right now, insurance is extremely cheap going forward. And given that we have an election later this year, it would be very prudent for those portfolios that are heavily correlated to the S&P to look at hedging at this point in time.
All right, moving on, Nick, I wanted to just highlight the dollar index chart. And while it doesn't reflect that 60, 70 points that we're down in the post-inflation number, the dollar is just in a trade range muddle. And particularly noteworthy is that it's a mixed when you look at all of the cross currencies. And while the euro may generally be weak and the yen may be weak, the pound seems strong. The Canadian dollar and the Aussie dollar are surprisingly stronger than expected. And so you have a scenario where just there is very little clarity on the very short term technically on the dollar. I still do believe the dollar is poised for a meaningful trend move at some juncture, but right now there really is no sign of life here, and expecting this to remain range bound on at least the short term is the only call to make here.
And moving on to page 9, we have that gold futures chart. What do you guys think here?
Well, the technical outlook has changed slightly, but only slightly, from consolidation with a downtrending bias to horizontal consolidation with a potential to develop into a new uptrend. The trend of lower highs has broken. We now have a newer swing high coming off of a swing low that could have been a double bottom. I'm still hopeful for another puke down to 2250 to 2285, where I'll add to my longs aggressively if we get that opportunity.
Eric, I'm a little bit more bullish on gold here. The fact that we have consolidated for 2+ months in a very sideways range and trading virtually along its 52-week highs. We have the 2400 level ready for a potential breakout. What makes it that much more bullish for me is that silver looks really good. Platinum is turning back up. Palladium seems to have put in a bottom. The gold miners are working their way higher. So we have actually the precious metals market certainly taking some accumulation, and it'll be really interesting to see whether or not the bulls can hold a breakout above 2,400 in this post-inflation number.
Now moving on to page 10, we have that uranium chart. Eric, what are your thoughts here?
Well, the big catalyst this week was news of a new tax on uranium production in Kazakhstan, which is where almost half of the world's uranium supply comes from. The new tax is expected to push global uranium prices higher. That might have been the catalyst to put a final bottom in this correction, which is now almost 6 months old. But frankly, I doubt it. The utilities are in no rush to buy on the physical market, and it's the dog days of summer with 0 pounds of physical uranium traded on most trading days. This market is coiled up and ready for a big move higher, but there's no reason for that to happen until the physical spot market for uranium starts to move with some real volume behind it. Right now, the physical market traders are all at the beach house for the summer. So it's anyone's guess whether this market looks ahead and starts to rally soon, or if we wait and see even lower prices through the end of August before this eventually turns around. One way or another, though, I expect the second half of 2024 to mark another big upleg in uranium and uranium mining shares. The question is just how long we wait for that move to start and whether we get an opportunity to add even more size to our longs if this correction deepens even farther from here.
Well, Eric, after an amazing 2023 run, the first 6 months of the year has just been one big uranium consolidation. We have now unwound the entire overbought state of this market, and we're starting to see it upticking. Now, will it be a meaningful breakout? We haven't seen the U308 yet confirm. Sprott is crawling off of its lows, but far cry from an official breakout. But we're seeing good accumulation in the uranium stocks, which are taking that news very well. So it'll be really interesting to see whether a start point for a potential new uranium move emerges here in the weeks to come. Finally, on page 11, I have that U.S. 10-year Treasury bond. And while we have seen yields declining, especially here in the post-inflation number down to about 420, bonds continue to crawl higher. I'm watching the 111 level on this Treasury bond. If we have a breakout there, we could easily come back to 113, 114, some of the highs we have seen in 2023. And while in the big picture, I'm not bullish bonds, I do think in this short-term environment going in to the tail end of the year, there is room for bonds to actually appreciate to the top end of their ranges. And so it'll be interesting to see how that follows through.
Patrick, you started a brand new YouTube channel dedicated to financial and trading education. Tell us more about it.
Well, thanks for asking. Over the last decade, we had been publishing an array of free market analysis, technical analysis, and options opportunities, but we have always reserved our core education for our paying members. We have decided that it's time for us to start sharing some of our favorite nuggets of investing and trading education. So I launched my new YouTube channel at Patrick_Ceresna. We have a lot of positive feedback from a few episodes back when we discussed a few Bob Farrell rules of investing in the postgame. So I put together a short video going through all 10. I'm very excited to start sharing with those interested. We have the link in the chart deck in the Research Roundup email, or you can just search for Patrick_Ceresna on YouTube.
Folks, check it out.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.